Alright guys, so something that a lot of people keep talking about is the rising risk of a recession, and a lot of people feel like we may actually have one in 2020, which would be very soon. Now, I'm not so much in that side of the camp myself, but I do think that we're probably overdue for a market correction because I'm just not seeing a lot of good deals out in the stock market at this time. So a healthy correction does make sense to me. Well, with that context in mind, I thought it would be fun to make a video today and talk about the top 5 stocks on my watch list. These are the highest priority stocks that I do not currently own myself. And they also trade kind of high, so that's why I'm not buying them yet. But if we were to have any kind of market dip, correction, or crash, or even just kind of on an individual basis, if any of these stocks give me a buying opportunity, I would love to pick up these stocks because they offer a ton of diversification to my tech heavy portfolio, and they also pay very nice dividends, except for just one stock on the list. But anyway, these are stocks that I'm like in love with. I just want them to dip a little bit because I think the prices are a little high. And you guys know that I like to buy stocks when they're actually going down. I know I I sound like a broken record. I always say that, but it's true. I like to buy my stocks when they're actually going down. So anyway, that's what we're going to talk about in today's video. I hope you guys enjoy this. If you do, please consider hitting the like button. It's a great way to support the channel without having to actually pay for anything. And it also means a lot to me. So let's not waste any more time. Let's go ahead and get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. Alright, let's not waste any time. Let's kick things off with stock number 5, and we're going to count down from least favorite to most favorite, and then we'll go down to stock number 1, which will be my most favorite. But starting off with stock number 5, that's going to be PepsiCo. Ticker symbol is PEP, and the reason I like this one is because they have a very nice dividend, which we will take a look at in just a second, but they also offer a ton of diversification to my tech heavy portfolio. And that's because PepsiCo is a world famous beverage company behind hugely popular soda brands like Pepsi, Mountain Dew, and Sierra Mist. But unlike some other beverage companies out there, PepsiCo is so large that they're even diversified into solid food offerings like Doritos, Lay's, Cheetos, and even Quaker. And I know what you guys are thinking, and let me say that I completely agree with you that these type of companies are a bit risky at this time because of changing consumer trends into healthier options. But instead of just giving up and dying off, in my opinion, PepsiCo is one of the few companies out there that is at least trying to adapt by offering low sugar options, smaller portion options, and are also diversified into areas like water with Aquafina and Life Water, coffee and tea drinks like Pure Leaf, and a partnership with Starbucks. They also offer sports drinks like Gatorade and Propel. They also offer juices like Naked and Tropicana, which, by the way, Naked has become an extremely popular juice brand lately as well. And they're even tapping into the high growth sparkling water markets through an acquisition of SodaStream, and by launching their own sparkling water line called Bubbly that they're hoping to turn into a billion-dollar brand. Well, it's reasonable to think that they actually have a shot at doing so, considering that while the traditional soda market has been really struggling in recent years, sparkling waters have been on fire. Now, it's not easy to find exact numbers on this market, but here's a report from USA Today that was published last year, and it talks about bottled water overtaking carbonated drinks for the first time in history in 2016, showing a clear sign that people are becoming more health conscious. And while carbonated soft drinks saw a massive 13 straight years of decline into 2017, sparkling waters actually grew from $2.6 billion in 2011 to over $6 billion in 2016, and that was expected to climb even more to over $8.5 billion the year after. Following that trend, we could potentially be talking about a market that is worth around $16 billion today, and that's just in the United States alone. And we all know that internationally, sparkling water markets are possibly even bigger, especially in Europe. In any case, PepsiCo's diversification has helped them keep from falling off a cliff, as sales only dropped in 2016, but later recovered in the following years by higher and higher rates. In any case, this isn't really a growth stock as much as it is a reliable dividend play. See, they've grown that dividend for close to 50 years in a row, which is pretty crazy. And even after all of that growth, they're still growing it it at almost a double-digit rate and still yielding close to 3%. Still, because I'm more of a growth investor myself, I just can't jump into a stock like Pepsi unless there is a huge drop in the stock, and that's what I'm really hoping for myself, as the stock is currently trading at record highs. There was a clear buying opportunity last year, but I was busy buying other stocks at the time, so I'm kind of waiting for it to dip again, as the valuation is still too high for me at this time. Still, for the dividend and for the diversification purposes, this is a stock that I cannot wait to buy on any kind of significant dip or buying opportunity and add to my portfolio for those reasons. Okay, so that was stock number 5. Now let's go to stock number 4, which is one that I like a little bit more, and that's going to be Caterpillar. Ticker symbol is CAT. Very cool ticker symbol there. And I've already talked about them a lot in previous videos, so I'll just keep this one kind of simple and to the point. Now, in my opinion, Caterpillar is an industry leader in heavy machinery with a very popular brand and strong moat. And the market is one that I don't think will ever disappear, as I see urban development as well as farming only growing and becoming more important in the future. But as it stands, the trade war with China as well as growing competition in Asia has been really taking a toll on their performance. In fact, their Asia Pacific sales actually dropped last quarter by a very large 13% year over year. That's very significant because Asia is actually the market where they're supposed to be tapping into growth, but things in China have just gotten so bad that it's making it hard for these US companies to really grow out there at this time. And as a result, their sales are actually expected to drop by 2% this year and another 4% the year after, which is drastically worse than the 15% and 22% growth that they saw in the years prior, although that was coming off of a drop of 17%. In other words, Caterpillar is a very cyclical stock that is heavily exposed to the macroeconomy. And I know you're thinking, why in the world would you be tracking a stock like this that can be so volatile? But the answer is because if the US goes into a recession or the global economy continues to weigh on Caterpillar, then I think the stock will tank, and I think it'll be an amazing buying opportunity for a strong brand company that pays out a mouth-watering dividend that has grown for 26 straight years, is still growing at almost 14% a year, has a low payout ratio of less than 40%, and still yields close to 3%. And keep in mind that even with the weak performance, they're still trading pretty close to their 52-week high. So you give me a market correction, and I think this stock will tank and that dividend yield will soar even higher, and I'll be trying to buy into that weakness. But even at its current levels, the stock is still trading cheaper than the sector. So a nice pullback, I think, would actually give a very nice buying opportunity. So similarly to PepsiCo, Caterpillar offers amazing diversification to my tech-heavy portfolio, and it also gives me a very nice dividend that continues to grow larger and larger at a high rate as well. So I kind of think of it as a little bit of a dividend growth stock as well. And you guys know how much I like dividend growth stocks. So anyway, Caterpillar number 4. Let's move on to stock number 3, and that's going to be my absolutely favorite energy stock, which I do not currently own any energy stock, so this would also diversify my portfolio as well. I guess unless you consider Tesla to be part of energy, which I do, so that is kind of a play there as well. But this is a much bigger kind of pure play on renewable energy especially, and that's really the future that I think we're heading towards over the long term. So that's why I really like this one, and they also pay out a nice dividend as well. But this company is, of course, Next Era Energy. Ticker symbol is NEE, coming in at stock number 3 on my watch list. Now, the stock has basically shot up like a rocket in the past 5 years, climbing by close to 140% over that time and close to 40% so far this year alone. So because they currently sit near record highs with a forward P ratio that is 17% higher than the sector, I just can't really convince myself to buy into this stock yet. But there's so many reasons to keep it on my watch list. For one, they're the world leader in energy production from wind and solar, and while I completely understand that topics related to climate right now have become very politicized lately, and there's definitely a lot of debate in this area, I still believe that renewable energy is, for the most part, the future of energy, and I'd rather own the disruptor rather than the disrupted over the long term. Keep in mind that the advanced energy market, which is mostly comprised of clean energy, is already worth over $200 billion in the United States and $1.6 trillion worldwide. That's up by hundreds of billions of dollars from just a couple years ago. By comparison, NextEra only brought in less than $17 billion last year, so there should be plenty of room for growth in the future as the market gets bigger. But while we have their sales up on the screen, we should mention that like most energy companies out there, sales often go up and down and can be pretty volatile. And while they are expected to soar this year by 16%, that's obviously reflected in the stock price already. So I'd rather wait until a downturn in the market before picking this one up. But keep in mind that even with those sales jumping around, management was still able to do a great job of turning them into profits, growing net income every single year and more than doubling it from 2015 up to last year, and are still expected to continue growing EPS by pretty close to a double-digit rate into the future. And that's not even mentioning my favorite part about this stock, and that's the beautiful dividend that has grown every year for the past 24 straight years, has a double-digit 5-year growth rate, and is still yielding above 2%, even though the stock is trading at record levels. So for me personally, NextEra is another one that is very similar to Caterpillar and PepsiCo in that it also offers me some diversification with a very nice growing dividend as well. So NextEra Energy, stock number 3, I really like it. All right guys, moving on to stock number 2, that's going to be one of my favorite giant companies out there, like one of those companies that if you were to ask yourself like which companies like have like a chance of taking over the world, this would be one of them, you know, kind of in the same sense of like Amazon or something like that. But they're a huge play on artificial intelligence and data, which by the way, I think data is going to be like the gold of the future. I think it's going to be hugely important in so many different areas. And there's really no company out there that stands out more to me in like data collection and processing and things like that than Google. Ticker symbol is GOOG or GOOGL, depending on which one you want to buy. And by the way, Google is the only stock on the list that I did actually own at one point in the past, but I ended up selling it because I needed the money for something personal, and I've kind of regretted it ever since because this is a company that is already so dominant, yet they still have so much room to keep growing in the future. Now, unlike the other stocks in today's video, Google is the only one on the list that does not currently pay a dividend, although that could technically change in the future. But as it stands, this is more of a share price appreciation play, and currently the stock has soared by around 126% in the past 5 years and over 21% so far this year alone, as they currently trade near record levels. There was actually a few dips this year that I was very close to taking advantage of myself, but held back out of, I don't know, stupidity, I guess. But in any case, their valuation is a bit rich at the moment, as both their forward PE and PEG ratios are higher than the sector, but that's not exactly a huge deal since I do think that Google deserves to always be trading for a premium to the sector, but it's still a little higher nonetheless. In any case, as far as performance goes, this is a company that has been absolutely on fire, growing their sales by close to 20% a year, despite doing well over $100 billion in revenue. That's pretty crazy, as they're expected to reach nearly $200 billion next year. That's because Google has done an amazing job of dominating markets like internet search at over 92% market share with Google Search, the internet browser market at 65% with Chrome, and the mobile operating system market at 77% with Android. It even comes in at number 1, even if you include desktop and Microsoft Windows. Now, they're even working on autonomous driving with Waymo. They have the 3rd largest cloud computing platform in the world with Google Cloud, and they also have a number of AI sub-companies like Verily, Calico, and DeepMind, all of which are working on healthcare related artificial intelligence, which could be huge in the future, not to mention Google Assistant that may also play a big role in AI in the future as well. So do I wish that I had not sold my position in Google in the past? Yes. Do I wish that I would have picked up Google during one of these numerous dips that we saw in the past year? Yes. But will I hesitate the next time that I see a buying opportunity in Google? No. Mark my words, I will own Google at some point in the future, and it will be a very long-term position. that is what I'm aiming for. All right, guys, and that leaves us with stock number 1, and that's going to be one of my absolute favorite dividend growth stocks in the market. I'm so bummed out that I have never purchased this stock in the past. I don't know why. I should have. Well, to be honest, it's a stock that rarely dips, and that's kind of why. But we'll take a look at that in a second. But they have a very stable business for the long term, and they continue to grow. It's very impressive, and they're a market leader. And that company is, of course, Visa. Ticker symbol is V, the payments processing giant. Now, over the past 5 years, Visa stock has rarely flinched, climbing by close to 200% over that time, and is also up by over 35% this year alone. And if we zoom out to the past decade, you can see just how smoothly this stock has soared over that time. That's because their performance is one of the most stable out there, as they consistently grow sales by double-digit rates every year, while their EPS is also expected to continue growing by north of 15% a year over the next 5 years. And surprisingly, even after all of that amazing performance, the stock technically still trades cheaper than the sector median, even though just in general a forward PE of 25 is still a bit rich. But in any case, there's plenty of reasons to think that Visa will be able to maintain their high growth given their amazingly popular and industry-leading brand, with the biggest real threats, in my opinion, only really being MasterCard and American Express. But even then, Visa commands way more market share. In fact, they control over half of the entire market, according to WalletHub.com. And by the way, this is a market that doesn't even give them any of the negative exposure that banks have to deal with when economies crumble and people can't pay back their credit cards. Companies like Visa and MasterCard are sort of immune to those credit delinquencies because they just collect a fee on the transactions but don't actually lend out any of the money. And even though Visa is a clear leader in the market, there's still plenty of room to grow in the future, considering that 85% of global transactions are still made using cash, according to the Motley Fool. This leaves them plenty of room to grow in new markets like Africa, the Middle East, and Asia especially, which, by the way, the newest phase 1 development on a trade deal with China reportedly has stipulations on granting better access to financial companies like Visa, for example, that have practically always been trying to enter the Chinese market in a more meaningful way. So once a trade deal actually gets done, that could be a huge opportunity for companies like Visa and its peers. But I haven't even mentioned one of the biggest reasons why I like Visa so much yet, and that's their very high growth dividend. Now, it's true that given the stock is trading near record highs and the payout is still very low at a payout ratio of only less than 20%, which I actually consider a good thing, but the result is that the yield is therefore very low as well at less than 1%. However, that dividend has been growing at a rate of over 20% a year with a double-digit growth history to go right along with it. So the way I see it, give me any kind of a dip on this stock, even if that's through like a market correction or crash or anything else. And this is absolutely one of the best stocks that I know that I should buy immediately because I love the brand, I love the performance, and I love the dividend. What more can I ask for? And I think it's already actually trading at somewhat of a reasonable price right now. So if it was to really dip in a significant way, man, that I would just be all over this stock. So this is priority number 1. It's at the very top of my watch list. So anyway, that's Visa. What did you guys think about the list? Did you enjoy the video? Do you agree with some of my stocks that I would like to pick up on any kind of dips? And are there any stocks that you would add to the list? Even if I already own them, like I'm sure most of you already know my portfolio, but even if I already own them, what are some stocks that you would like to buy yourselves during any kind of dip or buying opportunity? Let me know down in the comment section. I'll try to read and respond to as many as I can. And with that said, thank you so much for watching, and I will catch you guys in the next one. Take care. Bye-bye.